All right, ladies and gentlemen, welcome to Macro Ace with your host Tony. Apologies for the slight delay. Hopefully you can all hear me and you can also see the screen clearly. So we've got quite a bit to go through. Hello everyone in the chat as well, Case Lewis and Trader. So the ECB then. So first of all, we've got to go through what the deposit rate is and what the ECB rate decision is all about. But of course, the deposit rate is the first. The first is the interest rate paid by the ECB to banks having a deposit, and that's of course that's now different. That's now not negative. That's positive territory. The ECB provides the deposit facility where banks can place an excess reserves and an interest rate that is usually 100 basis points or percent below the main refinancing rate, which rate since no bank will lend money out less than what the S&P manufacturing PMI is at 46.6 versus prior 48.4. So there was a slight tick down there. S&P services at 48.2 versus prior 48.4. So not too much of a downward movement compared to the manufacturing sector. Consumer confidence data that we had a couple of days ago, or yesterday, was at minus 27.6 versus minus 28.8. The economic sentiment as well at 93.7 versus 97.6. The German IFO business climate as well, which is showing how the German businesses are, how confident that they are within the German economy, and what they think that business conditions are like for them. So again, at 84.3, unchanged from 84.3. The ZOO economic sentiment. So this is instead of asking businesses how they think that the economy is doing, this is them asking economists in Germany how they feel the economy is doing, and then how they feel that it's going to do in the future. So there, it was at minus 59.2 versus prior minus 60.5. So slightly better than before, but of course still in the negative territory there, meaning that the outlook is still not great for the German economy. The German CPI data as well at 10% versus 7.9% for the prior data, for the data that we had compared to the prior. So, going into double-digit inflation figures there. And the German HICP year-on-year at 10.9% versus 8.8%. So the key thing here is that Germany's economy is the biggest and strongest economy within Europe. Now, if they're facing double-digit inflation, what's the likelihood of the central bank taking bigger steps to increase their rates? Maybe a 75 is what is expected for both the main refinancing rate, which is otherwise known as the ECB interest rate, and the deposit rate. Okay, both looking for a 75 basis point hike on those there. So inflation being quite high in the strongest economy, and also still within the Eurozone, they have a big problem of trying to get it down. And as you can see, if the Eurozone did go into the double digits and then just kind of edged out of it, there's still quite a lot of work that probably needs to be done from the central bank. So if we kind of look at what the previous ECB meeting was like, so it's seen that they hiked by 75 basis points on the deposit rate and also the interest rate, the main refinancing rate. So you had the deposit rate, which is the 75 basis point hike to 1.25% from spot 5%. And then if we carried on, so the ECB staff had significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 2022, 5.5% in 2023, and 2.3% in 2024. So as said, if inflation is quite high in the strongest economy in Europe and the Eurozone, and also Europe itself, then they're expecting inflation to remain quite high for the foreseeable future. And that necessitates having super strong or super large rate hikes by the ECB. Price pressures continue to strengthen and broaden across the economy, and inflation may climb further in the near term. They also said that staff now expect the economy to grow by 3.1% in 2022, 0.9% in 2023, and 1.9% in 2024. Compared to the June estimates, you do see a slight revision towards the upside for the 2022 growth outlook compared with 2.8%. However, for 2023 and 2024, you do see that decline or slight revision towards the downside. And the only reason being as to why that would be is because the ECB is factoring in that whenever you raise interest rates, it takes about a year to have an effect on the economy overall. So for GDP, for all the productivity within the economy, that is expected to see a decline. And as we can see here evidently with the comparisons between the June estimate and the estimate that the ECB brought out in September. ECB officials also said that they don't exclude a 75 base point rate hike in October. There's been a lot of those comments that have been coming through from ECB members, Vassal, Nagel as well, talking about the possibility of a 75. A lot of the ECB members have been open to it, and they haven't shied away from saying that they need to continue tightening monetary policy. So a lot of the action and the comments that have been said have been priced in to within the euro currency, as much as they can do with all the other stuff that's been happening with the Bank of England and their buying of their QE or their bond buying that they did with Truss. Of course, is now left and replaced by replaced by Rishi Sunak. See, there's so many. This happens. It's just like such a quick change. You kind of get chopped up with the names. But the oil price expectations. So the ECB forecast assumes 2022 oil price of $105.04 a barrel. 2024 at $83.60 a barrel. And 2023 at $89.80 a barrel. So again, 2022, $105.40 a barrel. So quite precise there with where they see oil prices being as well. Now, it would be interesting to see whether or not they revise it higher. If they still feel that the Russia-Ukraine conflict is going to have a continuous effect and that it becomes has a much bigger effect. Of course, we're getting close to the winter season, and how are the European countries going to deal with the potential of running out of their gas storage as a possibility, right? Do they go to the Russians and make some sort of deal, or do they kind of try to bear with? So what does that do to energy prices overall within the market? Not just for natural gas prices on the TTF. TFF. So FX expectations as well. So the ECB forecast assume exchange rate of $1.05 in 2022. Great time on the euro dollar. We did go below parity beforehand, not too long ago. Now we're okay at the moment, but that's what they expect. So being close to parity is what they expect for the exchange rate this year and also in the next couple of years or so, as to whether the euro dollar is probably going to hover around. So not really, again, not presenting a nice picture for if you're going to exchange your euros to dollars, but that was their forecast or their expectation from the last meeting that they had. Also, the lending survey. So in Q4, banks expect a net decrease in firms' demand for loans. Also see sharply lower mortgage demand as well. Now, this is the current, just a nice image that we've got here, which pulled from Bloomberg article. So it shows the ECB council members and where they sit on the spectrum of being either being dovish or hawkish. Now, if you remember last time when I had this image, we knew that there were a lot more. So there was this little slider thing here, shall we say, was slightly towards the neutral zone, but now that's gone more towards the hawkish side. You can see a lot of the members who are remain quite hawkish are staying there. Holzman being more on the hawkish side than he was before, but overall, ECB hawks still have a lot of power and have a lot of sway with what they say. What they say goes. Compared to the ECB doves, who are open to the idea of a bigger rate hike, but they do cite that there could be, a major effect on economies, whereas the hawks say that it's needed to be done. You need to do 75 base point rate hikes, or you need to do big rate hikes in order to try and control inflation as their main target. So that is the current sitting as to the gauge of what we have. So key thing is most members are very hawkish, and that's of course had a big influence on ECB monetary policy decisions from the last time round, and of course this time round as well. The bets and expectations then. So Deutsche Bank, they expect 75 base point ECB rate hike in October versus previous forecast for 50 base point rate hike. So this is after, or the day after, the ECB rate decision had happened last time. The ECB had, also according to the Financial Times, the ECB has agreed to start discussions on shrinking its balance sheet in early October. So this is also quite key too. So quantitative tightening, and how the markets react to it as well. So other than raising rates by 75 basis points or doing bigger rate hikes, quantitative tightening is also quite key too. The central bank doesn't want to have too much on its books left when they've increased rates quite high. They want to kind of, either they could let the bonds that they bought to roll off, i.e. meaning let the bonds just finish their term that they have, or they can go super hawkish and say, well, actually, let's cut the bonds that we're holding now to try and pull liquidity from the economy, essentially. That's what it would do, other than having a rate hike on top. The other possibility, and I think somebody mentioned in this chat, said, hi, Tony, since the Bank of Canada raised their rates by spot 5% yesterday, are there any chances likely for Eurocat to go up if the rate ECBs are raised by 7.75% or more? So this is this is something I wanted to kind of discuss. As a possibility, what could happen is if the ECB does decide to go with a mega rate hike, let's say today, of 100 basis points, right? Then that means that they don't really have to cut their bond purchases sooner than needed. But if they do decide to go for a smaller rate hike out of nowhere, maybe like what the Bank of Canada did, then if they do go with a 50 base point hike instead, right, for either of those decisions, then they could mention it in the monetary policy report or in the statement, should I say, that they would look to maybe start cutting their bond purchases. Right? There's a mix of a hawkish and dovish action that's taken. That's a scenario that doesn't really make sense in this current environment. If they started on their aggressive rate hiking path, it doesn't make sense for them to kind of like pause right now, or so soon. If a lot of the members are open to a 75 base point hike in October from the last ECB statement that we had last time round. So if you're talking about the euro and the Canadian dollar and how that could react, if it comes in, like, we'll talk about how the markets have reacted beforehand, but if it comes in line with expectation, you wouldn't really expect too much of a market reaction to occur, right? Because it's priced in. No matter what currency pair you're trading, whether it be the euro CAD or CAD currency, if it's priced in and it comes in as expected, you're going to see a bit of a whipsawing that's going to happen, as we've seen in the past with other rate decisions from other central banks and also the ECB. And then you're going to kind of see the markets move, continue their move. However, if the ECB presents a very hawkish statement alongside the rate coming in as expected, or a very dovish statement, then you would expect more volatility to creep in. So if they do present a bleaker picture for the Eurozone with GDP, or they say inflation is, or whether they say that, on the flip side, they could say that inflation is way out of hand, that they underestimated it, or they need to do more to control it, or they forecast a recession, much sooner than they'd expect a recession to occur, or if they give us a precise quarter or time period, then that will add to volatility. So you're looking for the extremes in the comments from the ECB, and we'll look through ING's basic case scenario of what that could mean for the markets. So ECB Insider said a rate increase of 50 basis points rather than 75 basis points are likely in October. That was according to Econostream. Again, that was after the ECB rate hike. ING, then they said that with looming recession, recent market turmoil in the UK, and increasing financial risks, the ECB will have to tread very carefully, according to Brzezinski, an economist at ING, and they will have to balance between blind determination to fight inflation and a premature pivot. So they're walking a very fine line here at the moment, is basically what ING economist says. Then Goldman Sachs, they say that the ECB will likely decrease the pace of interest rate hikes later this year, based on recent statements from policymakers. In an October 14th study, economists led by Yari Sten predicted a 50 basis point increase in December, down from the previous projection of 75 basis points. So they also expect a 75 basis point increase later this month, of course, today, the second in the row. So Goldman Sachs is saying they're going to do 2 mega rate hikes, and then once they kind of reach the neutral rate, which a lot of, it's very unclear as to where that is within the ECB. There hasn't been a lot of talk from ECB members as to where that could be. But if it's around the 3% range, or if the restrictive rate is around the 3% range, and the neutral around 2% or just around that, then that could mean that we could see a slightly smaller rate hike in December. But that depends on what the ECB says today in their rate statement. So ECB member views. We've still got a bit to cover. We've got about 25 minutes left. So ECB member views. So majority of ECB members talking about QT, or AT, and when it should start. October 13th, you had Lagarde saying QT discussion has begun. It will continue. Nagel said that ECB should reduce the balance sheet in 2023. ECB hawks also see unwinding of the balance sheet to begin in early 2023. So if the hawks are the majority party, let's say, of the ECB at the moment, then the likelihood of a balance sheet reduction happening or unwinding happening in early 23 is quite likely if they're able to convince Lagarde, or if there's majority hawkish members. October 19th, Vassal said the ECB should hike by 75 basis points at the next 2 meetings. So this one and then the one in the December meeting. So then again, does it mean they should do 50? Well, if you're having members that are still looking for a 75 and the majority of them are hawks, doesn't really, you can't really say that 50 is on the table for this meeting, or maybe even for the December meeting. So there's going to be a mix of rhetoric that's going to be thrown around to kind of confuse the markets, I guess, and then also it's going to confuse the other ECB members to a degree, or make it a bit harder to kind of decide where to set the rate, or how strong to go. October 14th, he had ECB's Wren saying, I anticipate that QT will begin once neutral is reached in the first half of 2023. And ECB's staff model puts target consistent terminal rate at 2.25%. So around the 2% range. Again, you haven't really had other members, ECB members, saying where they expect would want the neutral rate to be. I think ages ago you had, I think it was ECB's Storneras, it was saying that 1.5% as the neutral rate. Seems crazy. That's for the main, if that's for the, if that's quite crazy. We're already at that with the deposit rate for the neutral rate. What else do we have? So this is ING, their crib sheet, right? It's quite key. So they nicely present what to kind of expect, right? So you have the rate decision. It could come in as expected, but then the rate statement itself could then move the markets in the completely opposite direction, or in a direction that causes a lot of volatility. So here's the base case scenario. So these are the expected comments to come out from the ECB, right? So the base case scenario is that they're expecting the ECB to say that inflation to stay quite high. It is to stay high. More hikes are needed to bring down medium term to back to target. The risk to the downside, particularly in the near term, a 75 base point hike, maintaining a fully dependent, data-dependent approach, and with a QE that they're unchanged. So that's their base case scenario at the moment as to what they see, what they're expecting to kind of happen or to come through with the rate statement. If we were looking at the more hawkish side, you can see here that inflation will likely be higher than forecasted over the medium term, hinting at 75 base point hike and hinting at more large hikes ahead, right? Rather than saying that they're data dependent, that they're actually saying that, yes, bigger rate hikes will be coming, there'll be more hikes coming in the future, rather than focusing on data. And hints that the balance sheet reduction is being discussed. So if you already have Lagarde saying that it'll start, it's already kind of begun, or it will begin. It's more of a repeat from what's already been said. So it's not completely brand new. The brand new thing would be if they do decide to say the balance sheet reduction will start in early 2023, and then you can see some nice volatility or movement towards the upside potentially for the euro. And then, of course, the biggest hawkish thing would be if there's a 100 base point hike that occurs at the ECB meeting today, rather than 75 for both the deposit and the main refinancing rate or the interest rate. And they say that more hikes to come. Also, then inflation is seen persistently above target in the projected period. That's also a key comment there, right? So you've got the inflation to stay high, or hawkish inflation will likely be higher than forecasted, and then very hawkish inflation seen persistently above the target in the projected period. Now for the dovish side, right, you can see that they just says upside risks in the near term, but medium term inflation may return to target. So there is a, that for a 50 base point hike or dovish style ECB, they would expect that inflation is kind of, going to decline over time without doing too much or without needing to do too much. Easy and jab. So would you say limit risk of volatility? It's best to take a trade when the statement comes rather than take it with the rate announcement. That's your choice. I'm just telling you. So remember, my job is to kind of make you aware of what could happen, and what's historically happened in the past, and then you kind of make your own decision. I'm not going to say what I'm not going to tell you how to trade. I'm just going to tell you what's happened. That's the role of market race. It's just historical facts of what's happened in the past, what are banks saying, what's been said by ECB members, and then you make a choice. You do what you want. All right. So that's ING's base case scenario. So this is the last rate decision we had in place about 10 seconds before the release. Okay. And then took a bit of time actually to come out, just remembering it. Okay, there you go. So the rate came in as expected. To be honest, you didn't see too much of a reaction from the decision off of the rate coming in, right, as expected. So same thing's going to happen, or could happen today, right? If you do get the rate decision coming in as expected, you're not expecting too much to occur. But if we do get something bigger or smaller than what's expected, then you expect more volatility. Just like what we saw with the Bank of Canada yesterday, right? They were expected to do a 75 base point hike, but they decided to go with a 50 base point hike to 3.75%. What happened was, of course, that was below expectation, right? Rather than going to 4%, and the Canadian dollar had weakened overall, and it took a massive hit. I think if I remember, on GBP CAD, there was about 96 pip move so that's what we could expect. Excuse me, just had a notification for my stream. Is everything going all right? Can you guys hear me okay? Is the speed all right for you? Hopefully you're not having any issues. I hope you're not. I don't want you guys to have any issues. Let's see, what else do I have? We all good? Okay, hopefully you can all hear me nicely. All right, good. So as I was saying, if the rate comes in as expected, you're not expecting too much volatility. But on the flip side, if you do get something bigger than expected or smaller than expected, then you will definitely see more volatility, like we saw with the Bank of Canada yesterday, with the unexpected 50 basis point hike rather than a 75, which was expected. So here we go. So yeah, of course, you did see a little bit of a movement, from the euro, but it wasn't that much. Anyways, so also definitely we've got US GDP today as well. So that's going to be fun for the US, the advanced data. Anyway, so we've got about 15 minutes left. So let me just double check. Well, let's get the deviations here as well, just so I can show you how the markets reacted beforehand. Right, where are we? So the ECB rate decision. So just ignore that for now. So here we go. This is when the rate came in as expected. You'd seen about 49 ticks towards the upside on the DAX. About 13 ticks towards the upside on stocks. About 9.5 pips down on the euro dollar. So what you can see here, currencies really didn't do too much, right? Because it's priced in. Surprisingly, you saw a bit more of a reaction from the FDAX or the DAX, right? Eurobonds or FGBL, what we'd seen as well, had seen a nice reaction there when the rate came in as expected. But this is the key thing here, right? If the rate comes in much higher than expected, so you can see here there's a 0.25% deviation, was 0.25% higher than expected. You'd seen on the DAX 102 ticks down, and the stocks 26 ticks down. Euro dollar seen a nicer, bigger reaction towards the upside here. And Euro GBP, Euro JPY had seen the biggest reaction then. And then you see these more of New Zealand dollar and the Aussie dollar had a nice reaction. So this is quite interesting. Now with the Japanese yen, they've been intervening in the market a lot more to try and stabilize their currency with the yen. So does it mean that the yen is, could it still be could you still get a decent amount from it? Well, that's yet to be seen. But from the US releases that I've done in the past, non-farm payrolls, especially when there was a nice big reaction, you would usually see, the biggest move happening on the Japanese yen, but with the Japanese yen. But this time, you can see here, it wasn't, right? You'd seen only about 24 pip move towards the upside on the dollar yen compared to, cable, which has seen 80.5 pips down. So could that mean it's the same thing with the Eurozone release here, or the ECB release that we have today, that you're not going to get as big as a reaction as you had seen in the past on the Euro JPY? That's a possibility. It's just something to be aware of what could occur or what could happen in the markets. The key thing is, anything below or higher than expected, you're going to see more volatility within the markets. If it's in line with expectation, might get something similar to what we had seen last time with not too much happening. But then we've also got to keep an eye on the statement too, as we've shown from the ING base case scenario, which is a very useful thing to look at. So now these deviations that I'm showing you here, right? You're thinking, how do I get my hands on these, right? So the easiest way you can get your hands on these is with signing up to the Macro Ace mailing list, right? The Macro Ace mailing list. Basically, what I do for you guys is put out an email of the first of all the upcoming economic releases that we'll be covering for the week, okay, and then also the live streams for the videos as well, what to expect in the Eurozone, the Europe session, the Asia session, the US session for the week, what the key things to kind of look out for, and a summary of the weekend news. It's quite short, it's about a couple of pages. It's not big because I like to keep it nice and short and sweet and to the point. Because we already have enough other bits of data to look at too. That's quite a bit. So that's sent every Sunday. One email that's sent to everyone else. Sent out to their feed if you subscribe to it. But yeah, as I said, if you want access to this, then you can have a look at or sign up to the main list, and you'll have access to that. Just remember the figures here, what it shows. So just in case you're wondering, why is there a bracket figure and a non-bracket? What does this all mean? So this is the initial market reaction going to the wick of the candle, right? The first candle. And then we have the reaction 10 minutes post the economic release. But that doesn't go to the wick, that just goes to where the candle had ended. Okay? Just to make that clear for you to understand, if you're kind of unsure as to how this kind of works. But yes, that's the deviations. We'll put that away. And also, where we're going to be getting the rate decision. Oh, MasterCard just came out. Okay, so a beat on their rev and a beat on the APS. All right, that's good. So they must have done quite well then. I haven't looked at them. I haven't looked at that yet. But it looks like MasterCard did well. All right, so let me get my tick strike up and running. We've got about 6 minutes. Now, financial juice is where we're going to be looking at the data, right? So we're going to get it in real time. Oh, well, from what I can see, there's a slight delay on the YouTube stream. But this is going to be in, financial juice will provide us with a real-time voice and text service, okay? So what that means is that, so what is a live voice and text service? What is that all about? Now, if you're not familiar with it or you're unsure about what it is, if you're a trader or a day trader, right, particularly if you're a day trader, you want to keep an eye out on what's moving the markets now, right? And a news platform like this is the perfect place to be able to do that, right? Because one, investment bankers use it to capitalize on potential trades or manage their risk for the day. Two, it's same goes for day traders too. It's live voice and text news in real time that can help those traders either capitalize on potential trade or manage trade as well, and also understand what's going on globally. You can look at the charts, but if you see a big movement happening and you're not sure why, then more than likely there's going to be a headline or a piece that's come out from somewhere. You might be trying to scramble you might be trying to scramble to find it, but we'll have it on our news site here. A lot of the times, sometimes there might not be any news, okay, and the markets will just move at the open, or there'll be something that's happened. But we'll always try our best to find out what that news is and then relay that to you on the microphone, or provide an article as well. So that is Financial Juice Pro, right? So you have your live voice there, you have your news feed here, you have your economic releases also coming out in real time as well, right? So that's also there too. The key thing is, if you want to kind of capitalize and have a little play around, if you have not come across a live voice and text service, you can sign up to Financial Juice Pro and you can get a 7-day free trial of Financial Juice Pro. Now, of course, there is trying to pin this message here. There we go. There's a link to get the 7-day free trial. It should have pinned. Okay. You should be able to, there we go. It's pinned for everyone. But have a go with the 7-day free trial. See what kind of what works for you. Does it work having a live voice to text feed? I mean, of course, if investment banks have access to this high grade level stuff, then why can't you? Right? So have a little play with it, see what you think. We've got about 6 minutes, 6 minutes left, not too long left. Also, we also have our new unusual activity service that we're providing, which if you like trading unusual volume activity in stocks, then you can join the free beta test group of our new service. So there we go. That is the link there. So not only for stocks, but also for crypto, for futures and currencies as well. You can join that beta test group. Again, it's free. We need your feedback to improve it or make changes to it, whatever you want to do with it. Don't forget to, if you do sign up to it, again, as I said, it's free. We just want your reviews, your thoughts on how the product or how. All right, we're good. We've got about 4 minutes left. So that basically kind of concludes the expectations of what to see from the ECB. I guess the key thing is if they do say that inflation is persistently higher than they expect it to be, and they do look to start mentioning quantitative tightening in early 2023, or if they go for a 100 basis point hike. As I said, I wouldn't be surprised if that happens with a 100 basis point hike today from the ECB. It's I do. Yeah, like I said, I wouldn't be surprised if it does happen. So again, median forecast is for it to be at 2% for the ECB interest rate and 1.5% for the deposit rate. Of course, a lot of all the central bank, all the investment banks are actually expecting 75 basis point rate hike for both of the rates. You did have, I think, earlier on at the beginning or after the rate decision happened, as said, I think it was Wells Fargo that was looking at a 50 for the rate decision before. But now that should be all good. But now, of course, they've upgraded their forecast to 75 basis point hike. Okay, there we go. Don't know how that disappeared there. All right, got tick strike running 2. So tick strike just basically allows you to listen in and look at how strong the buying or selling momentum is within, a stock or a currency pair or any futures contract that you're looking at. When all in one place. So we've got about a couple of minutes. So I'm going to try and explain this as quickly as I can. But again, tick strike measuring or showing you how strong the buying or selling momentum is within a certain asset that you're looking at. All right, we got about a minute left. Can't hear me? You should be able to hear me. Okay, 1 minute remaining. ECB interest rate coming out first. You should be able to hear me. I might have gone quiet for a little bit earlier on. Right. Let's see what happens. Let's see. Does the ECB go with this 100 base point? Let's see if they do surprise markets. This could either be very choppy or dirty. Okay, 10 seconds. Okay, so off the back of that data there, so it was as expected. Now we're looking at the statement. Let's have a quick look, shall we? See what the statement is saying. So you can see the euro going down. See what's happened. All right. Ooh, mama, there is a lot that's come out. Okay, interest rate on the main refinancing rate marginal. Yep, they increased as expected. Says with this third major policy rate increase in a row, ECB has made substantial progress in withdrawing monetary policy accommodation. What else have we got? Inflation remains far too high and will stay above target for an extended period. It's not saying persistently high. Monetary policy is aimed at reducing support for demand and guarding against risk of persistent upward shift in inflation expectations. Okay, nothing. All right, so they've done a 75 base point hike as expected. Didn't really get anything exciting from the statement itself. The only thing you could see, it could say is you know what? To be honest, that's not even a surprise either. Saying inflation remains far too high and will stay above the target for an extended period. So, anyway, that's the. I'm looking at the bund, the euro bund here. If you're just looking, if you're wondering what that was, yeah, that's the DAX, euro dollar. So actually, look at euro GBP. See what that did. All right, so whipsaw market reaction. Not too much of a market reaction, really. New GBP. Euro dollar, yeah, it's like a little flash move. I'm trying to see if they're talking about their QT. They don't mention quantitative tightening anywhere, from what I can see. Nada. Apologies if I'm making sounds like it. I'm trying to make sense of this here. Let's see. Yeah, this is boring. There's nothing surprising here. That's why you don't really see that much of a reaction from the euro at all. It's just kind of very choppy. As I said, it came in as expected. It was already priced in. So a little bit of a move towards the downside, but other than that, so what? We'll have to wait for all the press conference, I guess, now to see what if Lagarde decides to flip the switch. But I don't think from the last press conferences that we've done with Lagarde, she hasn't really deviated that much from what's been said in the statement. No real surprises. Yeah, so there we go. So we had euro falling to session low of $1. After the ECB raises by 75 basis points, and an unsurprising or a very dull and boring statement. Here we go. Come on, son. Come on, let's go. Let's go to parity, baby. Oh no. All right. Yeah, not much of a reaction. Okay, let's do some measurements anyway whilst we're here. Let's see how much of a move we had. Go. Let's go to the wick. So, all right, we had something at least. We had about 28.9 pip move towards the downside, but then that quickly went or tried to claw back its initial decline. Not as big as what we've seen in the past when, if we're looking at the past reactions, to be honest, with the last rate decision, there was it was a bigger move compared to the last rate decision on the euro dollar. Last time we got around about 10 pips or 9.5 pips down on the euro dollar. This time we're getting around 28.9 pips towards the downside. So I think it's the expectation for the ECB to be more hawkish with their statement hasn't really occurred. They haven't. Also, they haven't talked about whether they'd give another 75 at the next meeting, unless I missed it somewhere. But I cannot see that there in the statement, like they had done last time, right? That your members are looking, that there could be another 75 for the October meeting. Not saying for the December meeting. That hasn't. Another 75 basis point hike for the December meeting hasn't been mentioned as an open possibility. So a less hawkish than expected ECB, keeping the euro down from what I can see here. Overall, Euro GBP, yeah, same story. Let's look at the FDAX. Let's see what the DAX has done. Yeah, so it's just whippy. 40 ticks there. The Eurobonds. That was 53 ticks towards the upside. So, all right. A bigger reaction on the only thing I can say. Who says screen is not focused? Somebody said, what is his market in the right top corner? Because I can't see. This is Eurobond futures. Eurobond futures, if you're wondering what that is. Yeah. Hopefully you can all see that. Of course, we've got GDP in about 7 minutes, actually. 7 minutes for GDP. Tell you what, so a quick little heads up for the GDP data with the advanced data. Now, the advanced data compared to the second estimate or the final data usually has a bigger reaction. The reason being is, of course, it's the first reading on how strong or how productive the US economy has been, right? So if we do get, I think, just taking a blind look at the deviations. Actually, let me get up my deviations here. Why not? Why don't I do that with you guys now? Let's go through US GDP. So the last advanced GDP data that we had, okay? So when there was when we had seen minus 0.9% back on July 28th. Let's bring it up here for you. Okay, July 28th. Let me close tick strike now. So July 28th was when we got the second quarter data. Now we're getting the third quarter data, the advanced data. So we had seen that when there was a deviation of about at least 1%, then you'd seen that's the S&P. There's a bit of movement towards the downside, and Q had also seen a move towards the downside. The currencies were actually the biggest movers compared to, or had seen more volatility within the markets compared to the indexes or the indices. So the dollar yen, you can see there was a nice big move there. There was a nice big move there towards the downside, and that continued to stay towards the downside for about, after 10 minutes of trading. So you've seen 30.8 pips down. Also the other thing too, so the bond, 2-year bond prices and the 30 bond prices, bond prices had gone up by 38 ticks. So what we can see there on the 2-year bond as well. So key thing is, with what we've seen before in the past, is that if GDP doesn't isn't good, or if we do get at least a percent deviation, okay, on the GDP figures themselves, on the GDP figure itself, then what you could expect is a similar reaction where you see an initial downside move on the indices, but then of course it plays in the hand of maybe the Federal Reserve has done a lot more damage to the economy than what is actually, what they actually had wanted to do in the first place, or an engineered recession, let's say, right? If they've damaged the economy a lot more than they would have wanted to, then stocks would probably take that the Federal Reserve might actually press their brakes in the future on these mega rate hikes that they've been doing of 75. They might actually go with a 50 instead, sooner rather than later in 2023, or even at the upcoming meeting. That's a possibility. Everything is a possibility. But that's the key thing, is you could see a whipsaw reaction from the indices. But then obviously if GDP is much worse than expected, you'd expect a depreciation from the dollar currency. Now, dollar yen, is that going to be a decent trade? Is that going to have a big movement compared to what we've seen last time? But with the Japanese intervening, that might not happen, actually. You might not be able to see a big reaction from the dollar yen. Actually, talking about the euro release, let's do euro JPY, see what that did. I'll kind of give us a basis as to kind of what to expect. All right, so it's acting normal. Nothing on the euro JPY front, which is kind of scaring anyone. Let's see how much reaction was what happened here. Okay. So today might be okay for the release for the dollar yen reaction. It could still have the biggest reaction compared to all the other currency pairs. But if it doesn't, then interestingly enough, the dollar Swiss franc had a nice reaction. Then you're looking to you could look to the euro dollar, to cable or the New Zealand USD as your alternatives. But that was what happened. That's what happened last time round. So because GDP data hasn't really been that great as a market reaction. But again, I mean, I've just kind of gone through it here with you now. I might whoops. Can you guys still hear me? Hopefully I haven't disappeared. Uh-oh. Yeah. All right. We've just got our internet switched over. We're just getting stuff sorted. So apologies if it does cut in, cut out. All right. We've got a minute left. Right. So again, didn't really do too much prep for this here, but we see. Let's get up the dollar yen. Okay, let's look at the ES. Right, and then let's look at the ZT. 10 seconds. Oh. Well, I'm gonna have to go blind, boys. Okay, 2.6%. 2.6% higher than the forecast of 2.4%. Ooh. Oops. And I can't see anything else. Great. Keep an eye. Well, let's look at the euro. Euro dollar. Yeah, not too much reaction there. All right, so that will conclude the session. Thank you very much for joining me live. I will see you guys next time, tomorrow for the US consumer spending, actually. So let me get that video up for you guys so you can join me live for it. Okay, so that's the link for tomorrow's stream as well on the chat. We should be able to see it on the bottom. All right. Thank you very, very much. Hopefully that helped you guys with the ECB rate decision. Not a lot happened really with the ECB rate decision, even with the GDP data that we just had. Yeah. All right. We're good. Anyway, if we're looking from an economic standpoint of view, not from a a market, from an economic point of view, doing good in the US, right? After two back-to-back negative reads of GDP, positive GDP figure, finally, after a while. All right, thank you very much. Don't forget to join me tomorrow at 8 a.m. Eastern Time for the US consumer spending data.